Oh man, Tesla stock has some explaining to do. The stock was down 0.5% today following the release of the refreshed Model 3 in North America. That makes no sense. What we're going to talk about in this video might though, because we have the CPI report coming tomorrow. We're going to put that into context. We're going to go over Wall Street's estimates, what the big bank estimates are with JP Morgan, Bank of America, Barclays, Goldman, and what are my estimates? What do I think is going to happen? How am I positioned in my portfolio to take advantage of this? Now, tomorrow is the most important day of 2024 until at least January 31st. That's when you get the next Fed meeting. So tomorrow is going to dictate how the next 3-ish trading weeks trade in 2024. Believe me when I tell you this is a video you do not want to miss. On top of that, we're going to go over what Wall Street is saying about our markets. How is big money positioning and what are the stats that you need to know? First up, just a little bit of surprising, not surprising news following the leak from the SEC account yesterday, or the hack, if you will. They have approved 11 spot Bitcoin ETFs. This is specifically longer term bullish for Tesla. Now, I wouldn't be surprised, mark my words, potentially, to see a buy the rumor, sell the news event, as crypto has done so well leading into this ETF. Now, it is a halving year this year, and that tends to be very bullish as well, but don't be surprised if you get a little bit of weakness. Now, why is this bullish for Tesla? Well, Tesla owns about $500 million worth of Bitcoin. Longer term, these ETFs are going to open the door for more money to go into Bitcoin, which if Tesla continues to hold what they have, maybe even buy some more down the line, well, that should help out the price longer term, thus make Tesla more money. Let's briefly discuss what happened today with Tesla stock and the broader markets. I think people are trying to make this market a little bit more complicated than it actually is. The only thing that matters is inflation and a recession, or no recession. Those are the two things that will decide whether or not stocks do well in 2024. That's it. So if you don't get any news revolving those things, if nothing dramatic happens on any given day, you gotta look outside that spectrum. But again, focus on the main topic. For an example, CPI tomorrow is going to be epically important for stocks. If CPI falls faster than expected, that means the Fed can lower rates more. And that means the economy has a greater chance of not entering into a recession. Vice versa, if inflation continues higher and spikes, as some people are forecasting, some big banks are even forecasting, then that's a big problem, because that means the Fed will have to stay higher for longer, thus increase the odds of a recession. But as we've seen today, specifically why Tesla stock did poorly, it's not because they released a new Model 3 that's going to have a lot of demand. That's not negative. That's very positive. Tesla stock did poorly today really for two reasons. Some people are worried about January 24th, a potential disaster of an earnings call again. It sucks to see Tesla putting up good numbers. Things are going good for the business, but then Elon comes out and says, yeah, the economy's crap. It's obviously not great, and it hasn't been great for Tesla stock the last two earnings calls. The second thing is the mentality of sell first, ask questions later. Because what if CPI does come in hotter than expected? Tesla stock's going to get destroyed. But let me be the first to tell you, Tesla has already gotten destroyed, and it's likely already priced in the bad news from a hotter than expected CPI report or some other form of bad news. I mean, Tesla stock just in the last 2 weeks of trading has went from $265 down to $233.90. It's fallen almost every single day for the past 6, 7, 8, 9, 10 trading days now. Literally, it's been green, what, 1 day out of 10? I mean, come on. There's going to be a bounce. It's going to be aggressive. I think people are really starting to underestimate Tesla at this point, and that is very dangerous to do, because if you start doing that, then you're trying to get in, you're trying to get out, you're buying Tesla at 240, you're selling it at 230, Tesla stock jumps back to 245, you're buying the stock again, it falls back down to 240, you're selling it again, and that's a cycle that continues to go. Tesla's a stock, you own it, you don't trade it, but based on CPI reports, on the Fed, on this or that, Tesla stock's going to react a little different than other names. You also have to remember that short sellers lost $12.2 billion in Tesla stock last year. Out of the entire stock market, short sellers lost $193 billion last year. That means Tesla was over 10% of the entire loss that short sellers seen on the entire stock market. Yeah, it's going to be volatile. There's a lot of people that short Tesla that bet against Elon. It's very egotistical to bet against Elon, whether you agree with him or you don't. And if you don't, you probably hate him. If you're an investor, you probably short him. I think ultimately, the short interest being so high on Tesla, the $20 billion that's currently sold short in 2024 will be a positive for Tesla stock. But in the near term, it seems like people just want to borrow as many shares as possible to short as many shares as they possibly can. As I reported in the last video, cost to borrow fees for Tesla stock have now spiked to about 9%, which is very high. For context, Apple hasn't exactly been the most lovable stock in 2024. It's seen a lot of downgrades and a lot of weakness, while Apple's cost to borrow fees are only 1.47%. So Tesla has a lot of shorting activity. I should also clarify, the higher the cost to borrow fees, the more demand there is to short a stock. That hurts the stock on bad days or kind of nothing days like we've seen today when you didn't get a lot of news, but it really helps Tesla on good days, which tomorrow could potentially be one of those. Before we go ahead and get into expectations for CPI tomorrow and what that could do for Tesla stock, let's take a look at what the Fed just said today. Fed Williams, this is New York Fed President John Williams, says, quote, "It will only be appropriate to dial back the degree of policy restraint when we are confident that inflation is moving towards 2% on a sustained basis." Williams also said, "We still have a ways to go to get inflation back to the target, but we are clearly moving in the right direction. We're beginning to see significant progress on core services inflation. Core services ex-housing inflation has slowed considerably." Fed Williams also says, "I can't say when the Fed will lower rates. The Fed rate cut outlook makes sense. The timing depends on the economy." He's referring to the summary of economic projections, where the Fed said they're gonna cut rates about 3 times in 2024. Fed Williams also says rate cut prospects are tied to how the economy performs. So whenever Fed officials are saying rate cuts are tied to the economy, we're only gonna do 2 or 3 rate cuts, that's basically the Fed saying soft landing. So eventually that narrative will turn into a bullish one, but as of right now, markets and algorithms, they hear less rate cuts, they sell stocks. At some point, that will shift into, wow, the Fed thinks the economy is going to be good in 2024. That's good news. Fed Williams also says the fears of inflation getting stuck at high levels are not being borne out. So we're not seeing that so far. And keep in mind, Fed officials tend to get the CPI reports like a day or 2 before they're actually released. So I think that's why markets did react a little bit more to Fed Williams. He says inflation has been coming down pretty quickly. The Fed must be ready to react to unexpected events. That one kind of makes you turn your head or scratch your chin a little bit, like, what are you talking about? Unexpected events. That doesn't sound too good. He also says, "I am watching both hard and anecdotal data for economic clues." All in all, this drop that you've seen towards the end of the day before the violent bounce back in the last 10 minutes or so of the trading day, this was caused by John Williams. This news came out pretty much at the high of the day today. You can see this a little bit better on the small caps using IWM. It was right about here. Fed Williams comments came out, and yeah, that was all she wrote. back to some of the lower levels of the trading day. But overall, I think what he said was quite positive about tomorrow and the potential CPI report, and that's why especially IWM bounced back so aggressive. Now, in regards to tomorrow, CPI is going to be your main event, but you're also going to get Fed Barkin that speaks at 12:40 p.m. Eastern Standard Time, and initial jobless claims. Now, initial jobless claims are seen as a leading indicator because they are on a week-by-week basis. I'm specifically curious to see this one because people I've talked to have said after Christmas they've started laying people off, like business owners I've actually talked to in person, went to dinners with and conferences with. That's what they're saying, okay? So this is for the week of January 6th. So this is going to cover from the end of December until January 6th. We're only expecting 210,000 initial jobless claims, but if that number does come in high, that could also be a little bit larger of a problem, just considering, what time of the year this is, starting off New Year. CPI. Month over month core inflation is expected at 0.3%. That's the same as last month. This isn't going to be terrible if that's the number that comes out. But if you can come in at 0.2 or even 0.1, that's going to be important. Now, 0.1 looks a little bit less likely, and we'll discuss exactly why that is here in just a moment, but it's a possibility. Now, it's rounding, right? So if you come in at like 0.10, you're going to be at 0.1% month over month. If you come in at 0.04 technically, you're going to come in at 0% inflation. Even though there was some inflation, it gets rounded up and down. Okay, so even if you come in at like 0.026 or 0.26, you're still going to get rounded to 3. Or if you come in at 0.24, you're still going to get rounded down to 0.2. So you definitely want to watch to see what the actual number is. Not the rounded number, but the actual number, okay? Because even if you come in at like 0.18, 18 basis points, you're still going to get rounded to 0.2, but the markets might really love that number. But the rounding effect might kind of make it look strange. Your year-over-year CPI is expected at 3.8%. That is down from last month at 4% year-over-year. Headline inflation month-over-month expected at 0.2%. Last month was 0.1%. And year-over-year inflation expected at 3.2%. Estimate was last month was 3.1%. So your headline inflation seems a little high, right? It's projected to show a jump from last month. Your core month over month is expected to show no change from last month. And your year over year core is expected to show a pretty sizable down move in year over year core. So what do I think here? Just in a nutshell, I think expectations are too high, that inflation is going to come in lower. I don't know which exact data point is going to come in lower. I think core month over month probably comes in at 0.2. I think core year over year probably about spot on at about 3.8%. Headline could come in at 0.1% in line with last month. And year over year inflation on your headline could come in at 2.9%. I think overall it's going to be a solid beat tomorrow to CPI, just based on what I'm seeing out there, what I'm hearing from business owners, what we've heard on conference calls. I mean, if you listen to any of the conference calls last quarter, basically all of them were saying, we can't raise prices anymore. Specifically retailers like a Walmart was warning of deflation coming in the coming months. Target, Dollar General, same story everywhere. But yet expectations are high for inflation. Those two things don't add up to me at all. But we will see. Let me know down below in the comment section. Now, these are the expectations from big banks. This is what I mean by the rounding, right? If Bank of America is correct and inflation comes in at 0.26%, it's going to get rounded to 0.3% for your headline CPI, right? Same thing for core. Core Bank of America expects 0.27%. That's going to get rounded to 0.3%. If core CPI comes in at 0.24%, then it's going to get rounded to 0.2. So the rounding can make things look a lot better or a lot worse than they actually were. So we want to see what the actual number is itself, not necessarily just go off of the face value 0.2 or 0.3%. Okay, now basically all of these estimates are in the neighborhood of about 0.27% range. Some are a little bit higher, like Namura is 0.31%. UBS is 0.34%. If that were to happen, that would be an ugly response, right? Like, for an example, okay, UBS is 0.34%. That would get rounded down to 0.3. Take, for an example, JP Morgan. They expect 0.26%. That would get rounded up to 3, right? 0.3. So there's a big difference between 0.34 and 0.26, but they would still look the same on your just number you're going to see on the headlines, right? So that's why you want to look, because there's a big difference in reactions in the markets based on those two numbers. What's actually interesting is TD Securities has their estimate for core CPI at 0.14%. That's, half of UBS's estimate. That is half of Morgan Stanley's estimate. That's half of Deutsche Bank's estimate. That would be pretty spectacular. If that were to happen, you would see stocks have probably a 5% day on the Russell. Let's be honest. I don't think we're going to come in that low, but as long as we're like 0.2 and we get rounded down, that's going to be great news for stocks. 0.3%, I don't think it's going to be terrible as long as it's like a 0.29, 0.28 that gets rounded to 3. It's not going to be bad. But if you're around where UBS is and all the banks were basically wrong, and you're over 0.3 but get rounded down, that's going to be bad news, okay? Now, core CPI year over year, most of these guys are expecting on the higher end 4% from UBS. On the low end, you guessed it, TD Securities at 3.7%. Headline CPI, I don't think that's going to matter as much. Estimates vary a little bit more. TD Securities 0.19%, JP Morgan 0.2%, even some of the higher guys over here, Goldman Sachs is 0.29, Morgan Stanley 0.29. I don't think this is going to matter all too much. I think it's all about the core. So if we get a 0.2% number for Tesla or for CPI, Tesla is going to do very, very well, especially if it's along the lines of TD Securities, right? And it's like a 0.14 that gets rounded to 2 or maybe 0.15 or 0.16 that gets rounded to 2. That's going to be great news for our markets. I would expect Tesla stock could probably rally 3% on the low end to as high as 7% on the higher end, just because of how much damage you have taken recently. There's been a lot of damage in anticipation of the CPI report and Tesla earnings call itself, but a lot of this has been based on the CPI estimates, because the higher the Fed stays for longer, the worse it ultimately is going to be for Tesla, right? A 7% move would take Tesla stock to about $251 per share. A more conservative estimate, in my opinion, around, let's say 4%, would put Tesla stock back to about $243, which you were just there like 3 days ago. So that's why I think the move could be a little bit larger this time around, specifically with Tesla, because Tesla has just not been participating in this market as much as you would nearly expect. If you look at the SPY is flirting with new highs, right? Basically at that same level again. Now, to that point, if we get a strong CPI number, I'm not expecting big tech overall will do that well. I think it could be one of those days again where the Russell's up 3% and the SPY or the triple Qs are up 0.5%. I would expect to see a very large outperformance with small and mid-cap stocks and interest rate sensitive names as a whole. This was also some pretty bad news that I don't think is going to be a positive coming on Apple's earnings call. Apple iPhone sales in China fall 30% in the first week of 2024, according to Reuters. Apple's the biggest weighting in the S&P and the NASDAQ. So if they have troubles, it's going to push everything down with it. Liz Young, she runs SoFi Invest. She says small caps remain cheap versus the S&P 500. Even with the recent run-up, the Russell 2000 valuation currently ranks in the 12th percentile on this metric. Remember, valuations aren't great for market timing, but can suggest more or less opportunity over longer term periods. And yeah, you're at some of the lowest valuations you have seen for small caps in a very long time. It looks like Russell 2000 PEs are about 1.3 times lower than S&P 500 PEs. So you're nowhere near euphoric with your small caps. And for the first time in history, China saw a net annual withdrawal from overseas investors. This is one reason why, in particular, I recently bought Alibaba, because I mean, the government's going to step in when you're seeing almost $20 billion worth of inflows. Dollars, not wands, dollars of outflows. That's a problem the Chinese government does not want. That's why the Chinese government has recently started to buy stocks. If you guys would like to see all of the buys, sells, and trades we make every single day, check out that link down below in the description of this video. You can come trade with us, come chat with us, come learn. You have questions, we can clarify it. If you have questions on trading strategies or why I'm making a trade or how I'm making a trade, I also provide videos and lessons to learn. Brandon Balo says emerging markets are very cheap here. It's been 52 years since emerging markets were this cheap relative to US equities. What's your favorite emerging market play? Now, emerging markets are not going to do well if we do go into a recession or if the world gets worse from here. And that's another thing that kind of weighs on Tesla as well. Tesla is a US-based company. The majority of Tesla's single country sales come from the US. But if you combine China and and Europe, well, they sell more vehicles than the US itself in any given year. So they're almost grouped into emerging markets as well. Now, there are other regulatory risks that emerging markets have that Tesla does not have, because Tesla is a US-based company, like fraudulent numbers or something you might see with a Chinese company. But still, Tesla's kind of grouped in that category also. Point is, no recession, very bullish. And Tesla should benefit from this over the next couple of months. I imagine emerging market names, multinationals, can start to do a little bit better here, especially if you're interest rate sensitive, with high levels of growth. And that's Tesla to a literal T. Gina Martin Adams on X says the first quarter of positive growth for the 493 S&P 500 stocks that aren't the Magnificent Seven is expected to emerge in Q1 after a final quarter of shortfall is reported for Q4. Here is year-over-year net income growth for the Magnificent Seven versus 493 S&P 500 companies, and you can see the Magnificent Seven was really outperforming in 2023. But the expectation is, as we get to about mid-year and then towards the end of the year in 2024, around December, you could actually see the broader markets have better earnings growth than Magnificent Seven. That's way different than what you've seen in 2023. What you've seen in mid-year 2023 was the rest of the markets, 493 stocks, they were actually seeing negative year-over-year growth, whereas Magnificent Seven was not, as you can see right here. That is supposed to change. That's another reason why I do favor kind of broadening out the portfolio here. According to Bar Chart, speculators have built the largest NASDAQ long position in history. According to CFTC data, they say we're probably fine. This is one of those where you can't draw too many conclusions, but it doesn't tend to be a negative thing. It doesn't tend to be that bad, right? If you look at other positions in time where you have been very long, just take a look at this. This was back in 2016, 2017. You just pretty much straight rallied until the crash via the China trade wars in 2018. You basically went straight up as there was a lot of long positions on our markets. Back here, right, during this period, 2012 through 2014, The S&P went up like 80%. Kind of insane. It was literally straight up to the right. There was a lot of long positions. Right now, you're just seeing a huge spike, and we haven't had a lot of time to look at this, but it does not necessarily mean stocks have to fall. Fitch says we no longer expect a U.S. recession in 2024. We forecast 3 rate cuts this year. That would as well be along the lines of a soft landing. No recession, obviously, that's a soft landing, but only 3 rate cuts. So let's go ahead and wrap this up here. CPI, I think it's going to come in better than expected. I think expectations are too high based on the data that we already know, like companies over and over again last quarter saying deflation was coming, and that's what they are seeing. And all of the softer data that maybe the markets don't pick up on all the time, right? The markets don't reference Walmart CEO of what he said and how that's going to factor into deflationary numbers going ahead, right? So I think you have a little bit of an edge there, and I think that's one reason why Wall Street is too high on their CPI estimates. But in the odd chance that we come in, in a high 0.3, let's say 0.34, 0.32, maybe it still gets, lowered back down, rounded down to 0.3, but it's not a great number. Well, tomorrow's truly a make it or break it moment for Tesla specifically, because today you bounced off of your 200-day moving average. If you have a bad CPI report tomorrow, that's probably not going to happen the same way. You're vulnerable to fall to about $225 per share. That would be, a $9 fall from here. Almost $9 fall from here. That would not be too great. And that's going to put you back into this no man's land kind of range where you could pretty easily start to trend back to about $200 flat, right? So that could potentially be a problem. I think risk to reward is probably a 75% chance Tesla has a big green day tomorrow. Probably a 25% chance, maybe a 15% chance Tesla has a slight red day tomorrow, and probably a 10% chance Tesla has a large red day tomorrow. That's kind of along the lines that I'm thinking of, right? If Tesla was trading at $300, 270, 265, this would be a little bit different, right? I wouldn't expect such a large rally on a CPI beat, but you have fallen, the last 9 or 10 days, you've only been green one day. I mean, that's not great. All the technical indicators are also on the oversold side, like the RSI at 41.52, which if you look at the S&P, the S&P's RSI is at 65.46. I don't see a logical reason why Tesla's RSI is 24 points lower. That doesn't make any sense to me at all based on Q4 deliveries and what is going to be coming next, right? So these are reasons why I'm bullish on Tesla. Let me know down below in the comment section, what do you think about tomorrow's CPI report? Where do you think it takes the markets next? I think if anything, you're going to have an outperformance of interest rate sensitive names like a Tesla, like small caps, but I'm not expecting that big of an upside move for mega caps, for the SPY ETF, for the triple Qs, even if we have a really good CPI number, just because stocks are, very high right now. So that is going to do it for this video. If you guys want to come trade with us, check out that link down below in the description of this video. Hit the like button as well as subscribe to the channel. My name is Michael Tyler. Check out the X account as well, Michael Tyler over there, if you guys want to see all of these charts and data and things that we share over there before they're brought to you in these videos. That is a free way that you can do that also. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.